Can you get great investment ideas by following or watching the stock picks by some of the greatest investors in the world? Well, sometimes you can. Every 3 months, institutional investors and money managers, they have to declare to the SEC through their 13F filing what stocks they have bought, what stocks they are holding, and what stocks they are selling. And all of us can take a look at what they're doing. And the great thing is that we can see the stock picks of some of the greatest investors in the world. So when you go to websites like Guru Focus or Dataroma, they actually compile all these 13F filings from the SEC. And you can see the stock picks and the stock holdings of some of these super investors like Dan Loeb, Carl Icahn, Bill Ackman. You've got, of course, Warren Buffett, David Tepper, Lee Lu, Chase Coleman, Michael Burry, Stanley Druckenmiller, and many of these other people. And they even collate, for example, out of all these super investors, what are the stocks most held by these investors? Over here, the top 10 most owned stocks by super investors. So is this information of any value to us retail investors? Should we watch their stock picks and should we follow them? Well, first off, never ever follow any investor blindly, not even the greatest investors in the world. Why not? Well, there are 3 main reasons. Reason number 1. Now remember that in order to be a successful investor, you got to get 4 things right. There are 4 keys to successful investing. Number 1, you have to know what stocks to buy. Number 2, you have to know when to buy it at the right price. Number 3, you have to know how many shares to buy. How do you position your portfolio correctly? And number 4, you have to know when to sell. Now, the problem is that by looking at these stock picks, you may know what they bought, but you don't know when they bought it at what price. So the trouble with these filings is that they are filed every quarter and they have to file it within 45 days of that ending quarter. In other words, by the time they declare that they bought a stock, it could be more than 4 months after they bought it. And they could have bought it at a much lower price than what you could buy it for. So to them, it may be very profitable buying it undervalued, but by the time you buy it, it may be way overpriced. And the same thing goes for selling. They could sell a stock way before you get to know about it, 4 months before you get to know about it. And that's why be very careful. You may know what someone buys, but if you buy it at the wrong time, sell it at the wrong time, and you do not allocate it properly in your portfolio, like for example, they may only invest a small allocation, but you take a very big allocation, and it so happens that stock collapses, it doesn't affect them, but it may destroy your portfolio. So that's the first reason. The second reason is because that no matter how great an investor is, they do make mistakes. And if you follow them blindly, you may inadvertently buy their mistakes and miss out on the ones that they did well, for example, unless, of course, you buy everything. So I'll give you a good example. So one of the investors that I truly admire the most in the world, now no one comes close, is of course Warren Buffett. In fact, my investment methodology follows his methodology very, very closely. But of course, I have made a lot of modifications over the years. For example, I combine technical analysis and options trading together with value investing. And of course, the styles are slightly different in the sense that Buffett likes to invest into oil companies, but I will never touch oil companies. But also because the funny thing is, as much as I love Buffett, I have to point out that there were many times when he did not follow his own advice. So for example, in the 1980s, I heard a speech that he gave, and he said, never invest in airlines because they are very lousy businesses. And what did he do? In 2019, he did not follow his own advice. He bought many of the major airlines in the US, and then COVID hit, the airlines collapsed, and he sold it at a huge loss, and then the airlines rebounded. And he also said many years ago that he doesn't understand technology stocks. And then he went to buy IBM, which he then lost a lot of money as well. So there are many stocks that Buffett has bought over the years, like the airlines, like General Motors, like Occidental Petroleum, IBM, Coca-Cola, American Express, Kraft Heinz. And these are all the stocks that I did not buy because they did not fit my investment criteria. And I knew that Some of them went against his own advice as well. But of course, I bought stocks that he bought as well. Like, for example, I bought MasterCard, I bought Visa, I bought Apple. So the point is that even though you admire someone, they're a great investor, don't buy everything that they buy. Buy some things they buy, but avoid some of the things that they buy. And the only way to do that is when you are clear on your own investment strategy. So as an investor, it's very important for you to have your own investment strategy. That before you buy something, you got to have a set criteria that must be met before you make an investment. So for example, many of you know that I only invest in the top 1% of companies in the world, and they have to meet my 7-step criteria. So sometimes I may get great ideas by watching what super investors are buying, but just because they buy doesn't mean I follow them. But once I see that they're buying something, I'll take that idea and I'll put it through my 7-step criteria. If it meets my criteria, sure, I'll buy it. I'll take that idea they had. But if it doesn't meet my criteria, which is most of the time, then even if the greatest investors buy it, I'm not going to buy it, right? And not only that, but in your investment strategy, you have to be clear about what kind of stocks you are buying. And again, there are many different styles to it, and there's no right or wrong. So for example, there are 8 different investment categories. Like some investors, they like to focus on buying high quality growth businesses. And that's me. Most of my stocks, in fact, about 50% of my portfolio are in large growth companies. Your Microsofts, your Nvidia, your Fortinet, your Palo Alto, your Mercado Libres, large cap growth companies. Now, I also have an allocation to very defensive, predictable companies, which are not high growth, they are mid growth, but they are more defensive. Stocks like your McDonald's, your United Health, like S&P Global, these are very defensive kind of stocks. Most of them are in healthcare or consumer staples. Now, some great investors make a lot of money on cyclical kind of stocks, but it's not my style. So I tend to avoid very cyclical stocks where their revenues and profits go through big ups and downs, and they are very tied to the sensitivity of the economy. For example, like real estate stocks, I tend to avoid industrial stocks, oil and gas stocks, commodity stocks. So these are cyclical stocks. And again, there's nothing wrong with it. Some great investors buy it, make a lot of money from it, but I stay away from it because it's not my style. How about speculative growth stocks? Again, I don't usually buy speculative growth stocks. These are companies that are in the early stages of growth. Their revenues can double and triple, but they are usually not very profitable. And again, there are some investors that make a lot of money on speculative growth stocks. But again, I buy once in a while, but most of the time I tend to avoid these speculative growth stocks. Turnaround companies, I buy once in a while, but lately I've been avoiding turnaround companies as well. Dividend stocks. So do I buy dividend stocks? Yes, I do, but they're in my separate dividend portfolio. Deep value stocks. This is something that I avoid as well. So again, there are great investors. In fact, like Michael Burry, he loves to buy deep value stocks. Monish Prabhai, he likes to buy deep value stocks. Warren Buffett, in his younger days, he used to buy deep value stocks. So I avoid deep value stocks. Deep value stocks are usually not high quality companies. They're usually okay companies, but they are usually selling way below their book value. And you're usually buying them so cheap that you try to turn it around for a profit once there's a bit of a recovery. But it's not something you want to hold long run. And how about ETFs? Yes, I do own some ETFs when I'm very bullish on a specific industry. For example, medical devices. I've got the medical devices ETFs as well as the semiconductor ETFs. So you got to know your investment boundaries or your investment universe and stick to those areas that you're comfortable with, that you have a core competence in. Now, at the same time, in your investment strategy, you have to also be clear about the kind of sectors that you want to focus on and the kind of sectors that you want to avoid. So personally, I only like to buy stocks that are within certain sectors. For example, a big part of my portfolio are in stocks that are in the technology sector, in the consumer discretionary sector, and in the healthcare sector. Why? Very simple, because you can see that in the long run, it is these three sectors that tend to outperform the S&P 500, because stocks within these three sectors tend to have higher profit margins, stronger economic moats, and higher growth and higher return on capital. I do have some financial stocks, but I tend to avoid banks and insurance companies because, again, they tend to be more cyclical with lower margins and lower growth. I prefer financial stocks that are more defensive with more recurring income. And there are certain sectors which I avoid completely. So I avoid real estate completely. So some guru may buy a lot of real estate stocks. I don't buy real estate stocks. Some gurus may buy a lot of energy stocks, like Warren Buffett loves oil and gas stocks. I never touch energy stocks as an investment. I may trade it with options, but I don't buy it as a long-term investment. I avoid utility stocks. I avoid commodity, or known as material stocks. So why do I avoid these sectors? Because you can see in the long run, these sectors tend to underperform the S&P 500 because companies within these sectors are very competitive with lower profit margins, lower return in capital, and lower growth in earnings. And there are certain industries I avoid completely. As you guys know, I avoid any auto companies, whether it's electric vehicles or legacy auto companies. I avoid airlines. I avoid shipping stocks as well, for example. So once you're clear on your investment strategy, then you can take a look at what these super investors are buying and what stocks that they have bought that may fit your strategy. And these are the ones that you can then invest in. And of course, you have to ensure that it's at the right price. You must know exactly when to buy the stocks when they're undervalued, how many shares to buy to ensure a proper allocation to your portfolio so it's not over allocated or under allocated. And the last thing is you must know when to sell to take profits. Don't sell too early, don't sell too late. So with this knowledge, with this strategy, let's dive in and let's take a look at whether we can get some great investment ideas from the recent 13F filings. So there are many super investors that you could follow, and you may want to pick the ones that kind of like fit your investment style. So for example, if you look at Michael Burry, who is famous for shorting the subprime mortgage crisis, I don't really follow what he's buying most of the time because he tends to be more of a very short-term trader versus more of a longer-term investor. So it doesn't really match my style. And he also likes to many times go for very deep value stocks that again is not within my investment style. So I would like to, for example, look at someone like Bill Ackman, which is kind of like closer to my style of investing. So for Bill Ackman, if you take a look, he didn't have any new buys or new ads in the recent quarter. In fact, he had only one transaction, which was he was reducing his stake in Chipotle, and the rest of the stocks like Hilton, Restaurant Brands International, Google, Howard Hughes, Canadian, Pacific, Kansas City, no changes, right? So these were buys he did previously, and I can see out of all of them, the only one which I share in common is, of course, Google. Now, I didn't follow him in Google. I think I bought Google much earlier than he bought Google. But for the rest of the stocks, it didn't meet my investment criteria, so I never bought any of them, except Chipotle. Chipotle meets my investment criteria, but I never bought it because it was too expensive to me. It didn't meet my price because I was waiting for it to be undervalued, and it didn't get cheap enough for me to be compelled to buy it, right? Let's see. Going down the list, Warren Buffett. I always take a look at what Buffett is buying. And by the way, he just disclosed a mystery buy that he's been teasing for a while. Because for the longest time, he kept saying there's nothing to buy, everything is too expensive, he's sitting on so much cash. And then he went out to buy something, which he just disclosed. And what did he buy? He bought this stock called Chubb Limited, ticker symbol CB. And he added 28% in the recent quarter to this position. So that's something new that, hey, I'd like to take a look at. Now, we all know he reduced his stake in Apple for, I don't know what reason, right? He didn't really give a very clear explanation in his AGM. So again, he added Occidental Petroleum. So again, would I buy that? No, doesn't meet my investment criteria. I don't buy oil and gas stocks. I may trade them as an options trade, a one-night stand, but I don't invest in oil and gas stocks. Liberty Sirius. This is a radio company, right? He added to that as well. So what could I look at? I could look at Chubb, the new buy that he had, and Liberty Sirius. So does it meet my investment criteria? Well, let's start with Chubb, shall we? So again, there are many things I look at. I've got a 7-step criteria, and I'll show you some of the steps that I look at. So one of the first things I want to ensure of when I look at a stock is I want to make sure that it has a history of consistent growing revenue, profits, and free cash flow. Then I know that the business is resilient, it's predictable, and it's consistent. That's something really important to me. So looking at the history, does it have consistently growing revenue? Yes, it does. Does it have consistently growing net profit? Well, it's a bit up and down, but generally it's on an uptrend. All right, it's not perfectly up every year, but the trend is more or less going up. So okay, all right, not too bad. Next, free cash flow. I want to ensure that the free cash flow is increasing consistently over the last 5 to 10 years. In blue, the free cash flow is increasing. Okay, not too bad, right? So passes that first thing that I look for. Next, I like to look at return on capital. I like to invest in companies that have a high return on equity and return on invested capital of at least 15%, ideally. So you can see ROE, right? It's above 15%, all right? Pretty good. But ROIC is actually below 15%. So usually I want return on invested capital more than 15%. However, this is a financial stock. It's in the insurance business, which actually I don't really like. I told you, right? I don't really like insurance as much. But I may still buy if it's a really good deal, right? And usually for financial stocks, the ROIC is much lower. So because it's an insurance stock, I can close one eye on the ROIC, which usually I require at least 15%. I'll say, okay, the ROE is 16%. Okay, I could pass that, right? Then other things I look at would be some of the debt ratios, like does it have too much debt? Things like debt to EBITDA ratio, okay, that's fine. That's not too high. Interest coverage, pretty high. That's very good. You want this to be high. You want this to be low. Okay, not too bad. That passes. Now, one of the most important things to me is I like to invest in companies that have a strong economic moat, a sustainable competitive advantage that protects the business from competition. So competitors are not able to easily take away market share, take away their customers. In other words, I like to invest in companies that are near monopolies. They have no competition or their competitors are very insignificant. Okay? We call them white moat companies. So for Chubb, which is an insurance company, is it a white moat company with no competitors, or are there some big competitors? Yeah, they have some big competitors. Insurance is a pretty much commoditized industry, so there is quite a bit of competition. So it's not a wide moat company, it's a narrow moat company. And in fact, if you're not sure, you can actually just check with ChatGPT or Meta AI or Gemini. You know, all these AIs can actually give you an idea of the moat. Where's that one? Yeah, there we are, right? So on a scale of 1 to 10, 10 means a very strong moat, 1 means there's no moat. So ideally, I like to invest in companies where the moat is ideally 8 or more, which means that the moat is pretty strong. And interestingly, actually, they gave a moat of 8. So even though it's an insurance company with usually a narrow moat, actually the moat is pretty strong, which surprises me actually for an insurance company. So why does it have a strong moat? They have brand loyalty and pricing power, interestingly, because of their long-standing reputation and exceptional underwriting expertise and risk selection. So sure enough, Chubb is actually pretty reputable brand in the world. I have to say that, right? They've got high barriers to entry. They've got high customer switching costs that gives it a lot of the moat, but they lack a network effect and they lack economies of scale. But all in all, I would say it has a pretty strong moat, interestingly enough. Okay? And the next thing I like to look at is I like to compare the stock with the S&P 500 over the long run. Does it outperform the S&P by a big margin? If it doesn't, why bother? I might as well buy the S&P 500, right? Okay, so if I put in the S&P ETF, SPY, and then I compare it to Chubb, and I look at the last 5 years, well, you can see in the last 5 years, Chubb did not outperform the S&P 500. Okay, how about the last 10 years? Let's go back 10 years, back to 2014, and you can see that, Chubb in the last 10 years also did not outperform the S&P 500. So to me, it's like, why even bother buying a stock when it can't be the S&P in the last 5 or 10 years? I might as well buy the S&P 500, right? Okay, so because of that, I don't think I'm going to buy Chubb. Okay. So you see my thought process going through that? That's just one example. Shall we take a look at a lot more examples like Liberty Sirius or other stocks that have been bought by other great investors? Let's do that, but I've run out of time in this video, so let's do it in part 2 of this video. So I'll see you guys in part 2. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.